Hello and welcome to Portfolio Matters, week 112, and I'm recording this on a beautiful morning in Crete. It will be an abbreviated update, but before I get into it, a quick disclaimer. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we'll be discussing securities that we own or have financial interest in. Please do your own research or consult professional investment advice before making any decisions regarding topics on the show. A full disclaimer can be found at the end. Okay, news this week. Well, the big news this week was that OPEC Plus met and announced a totally unexpected cut in production of 1.15 million barrels starting in May. Now, to me, this shows the declining influence of the US in the Middle East, and Saudi Arabia, who led the cuts, are increasingly following their own self-interest in the world rather than the US's. So OPEC has pricing power when it is a large proportion of global supply, and it currently controls about 60% of global exports. So it has pricing power, but also when there is a lack of surplus capacity and the shale revolution seems to be slowing and the growth in shale output has stalled. Therefore, when OPEC Plus cuts, there is no immediate supply response from the rest of the world. So OPEC Plus currently has pricing power and it is using it. Elsewhere, the ECB has called for a clampdown on commercial real estate funds over fears that liquidity mismatches could cause financial instability. And it has suggested reducing the frequency at which investors can withdraw their money, instituting minimum holding periods, or requiring longer notice periods. So the basic problem is that these funds, you can request to withdraw your money immediately, but the underlying fund needs to sell the properties to produce the cash to give it to you back. And that liquidity mismatch can cause problems. So the Blackstone Real Estate Income Trust has received 4.5 billion in withdrawal requests in March, and it has assets of 70 billion. So these are the production cuts announced by OPEC Plus this week. Saudi Arabia can be trusted to actually go through with them. Not sure about the rest. Now, one thing that we are concerned about and looking at is deposits in the US banking system. And following the failure of Silicon Valley Bank and Signature Bank, deposits continue to fall. We'll have more on that later on. Okay, on to this week's economic data, and there's quite a lot of it. So in the UK, we had nationwide house prices, which beat expectations, rising in March against expectations of a fall. And that is now 2 months in a row that UK house prices have risen. We had UK construction PMIs, and they massively missed expectations. So they're expected at 53.8, down slightly from February, and they fell to 50.7, a big miss, but still in expansion territory. Now, we also had Eurozone inflation numbers for March, and they were good. They were generally better than expected. So CPI came in at 6.9%, well down on February and beating expectations. Month on month, it was 0.9%, which is again better than expectations, but slightly up on February. However, the bad news was that core CPI met expectations at 5.7%, and that was up on February. So core inflation in the Eurozone continues to rise. Producer price inflation fell and fell more than expected. So it's expected at minus 0.3%, came in at minus 0.5%. Year on year, it was at 13.2%, well down on January, but still much higher than the ECB would like. You also had Eurozone construction PMIs. They were very poor. Expected at 49.1, came in at 45. Moving on to China, the Caixin manufacturing PMI for March was worse than expected at 51.7, came in at 50, but non-manufacturing, i.e. services, were better than expected, coming in at a very good 57.8, well up on expectations. And as a result, the composite met expectations. Okay, moving on to the US, we had personal income for February. That was slightly up on expectations at 0.3%, but personal spending was down slightly on expectations, coming in at 0.2%. We also had the Fed's favored inflation numbers out last Friday, PCE inflation, and these were slightly reassuring. So PCE inflation year on year for February came in at 5.0%, beating expectations of 5.1 and slightly down on 5.3% in January. Month on month, it was much better than expected, coming at 0.3% in February, better than the 0.6% expected and the 0.6% in January. Core PCE inflation also slightly beat expectations, coming at 4.6%, down on 4.7% in January, and better than expectations, but that is still way too high for the Fed to be comfortable. Month on month came in at 0.3%, again, better than expected. Now, we also had the ISM numbers, and they generally show that the bounce we saw in services in February faded in March. So the manufacturing PMI continued to weaken, coming in at 46.3, massively meeting expectations, and all the manufacturing data were disappointing. New orders came in at 44.3, massively missing expectations. The non-manufacturing PMI was expected at 54.5, came in at 51.2. That's a big miss and well down on February. Employment came in at 51.3, missing expectations, well down on February. The good news is that prices paid, both for manufacturing and non-manufacturing, also miss expectations. So inflationary pressures seem to be easing. New orders in the non-manufacturing sector also massively missed expectations, coming in at 52.2 against expectations of 62. That's a huge miss and shows that the non-manufacturing sector seems to be slowing, showing that the bounce we saw in services in February has faded sharply in March, although 52.2 is still in expansion territory. Construction spending in February fell, and that's the first time we've seen that. So that came in at minus 0.1% month on month. Against expectations, it'd be flat. Now, something we haven't reported before is the US LMI Logistics Managers Index, and that is an index of activity in the logistics sector, so moving goods around the country. And in March, that fell to an all-time low of 51.1. The series only started in 2016, but it shows slowing activity in the US economy. Now, the other big news of the week was US JOLTS, job openings, and that slowed more than expected. Market was expecting 10.4 million job openings, but it actually came in at 9.93 in February, and the market took that badly. Job quits, however, came in at a very respectable 4.0 million, higher than expectations. But the ADP numbers came out earlier in the week, and they showed that The US only created 145,000 jobs in March. That was below expectations and well down on February. So if the non-farm payrolls follow that, then March job numbers could be disappointing. The challenger job cuts numbers rose in March and again were higher than expectations. So US employers are starting to cut jobs. We also had some quarterly numbers for the UK. Pause and take a look. The good news is that the UK current account came in much better than expected. Now, the UK current account only does well when the UK economy is doing very badly, and we have cut down on our imports. So that is a double-edged sword. Okay, some charts. So this is UK nationwide house price index, and it's actually been rising for 3 months now, very much against expectations, as house prices are very high and have risen substantially since the pandemic. And we now have mortgage rates above 6%. So house price affordability is very stretched. Year on year, though, house price inflation continues to fall. This is UK construction PMI, which has held on remarkably well and is still above 50, but fell last month. Eurozone CPI fell sharply, which is good news, driven by energy prices. Month on month, though, it was still plus 0.9%. Core CPI continued to rise, and that will concern the ECB, and there is nothing in that chart to suggest inflation in the Eurozone is under control. Eurozone producer price inflation fell month on month, which is good news. Reminder, PPI leads CPI, and this is the year-on-year figure. The EU construction PMIs fell further and are now fairly deep in contraction territory and have been in there for some time. This is US personal income month on month, and that continues to grow at a respectable rate. Spending slowed sharply in February and suggests that some of that enormous rise in personal spending in January was the result of an overly generous seasonal adjustment. PCE inflation continues to come down as plus 0.3% in February, but the core number remains persistently high, and although it's coming down, it is coming down very slowly. The Fed will not be encouraged by the persistence of core inflation in the US. Month on month, it was plus 0.3%. Manufacturing sector continues to slow, and that is a new low. US manufacturers' employment intentions are falling. New orders fell, and prices paid ticked back down. In the non-manufacturing sector, the bounce we saw in the first 2 months of the year has faded, although that remains in expansion territory. Employment intentions fell. Good news is prices paid fell sharply, so inflationary pressures in the services sector seem to be fading quickly. New orders fell very sharply. Reminder, though, that the S&P Global Services PMI, which came out a few weeks ago, showed a strong bounce in services in March. So once again, the ISM and the S&P Global numbers are diverging. JOLTS job openings fell sharply, but there are still 1.7 jobs in the US for each unemployed person. The labor market remains tight, although it is weakening. Quits rose, so workers remain confident that they can leave their job and find another one. The ADP numbers came out and they showed a weakening in employment growth. So reminder that the non-farm payrolls are out later today. Challenger job cuts showed a rise in March, and so US employers are laying more people off. Factory orders are down again, but there's actually been a rise in the economic optimism of US consumers. The IBD TIPP optimism index is constructed from a survey of 1,000 US consumers. And actually their confidence is the highest it's been for a year. Construction spending fell in February, and retail sales, actually the trend remains down, but it ticked up last week, year on year. And this is the Logistics Managers Index, which hit an all-time low since the index began in 2016. I have included a description of the index. Pause and have a read. Now, the US MBA 30-year mortgage rate ticked down slightly, but is still very high. It was around 3% during the pandemic. It is now 6.5%. So housing affordability is going to be very stretched. The mortgage market index showing activity in the mortgage market remains very subdued. People are not taking out either residential or commercial mortgages. Initial jobless claims ticked down from last week. So we're not yet seeing a sustained rise in jobless claims, although continuing jobless claims continue to rise. In China, the manufacturing PMI unexpectedly declined. So we were expecting a strong rebound in the Chinese economy, and in the manufacturing sector, that is not happening. But in the non-manufacturing sector, it definitely is. That is a very strong number. So everywhere, the manufacturing sector is struggling, but the service sector is doing much better. And this is the composite which met expectations and is a decently strong number for China. So in summary, EU CPI fell more than expected, but core inflation continued to rise, and everywhere core inflation remains uncomfortably persistent. In the US, core inflation remains 4.6% and shows little sign of coming down. The ISM manufacturing PMI in the US fell further into contraction, but the big news was the non-manufacturing PMI, which shows that services lost a lot of momentum in March. And in general, the data this week was weak. Are we starting to see the forecasted weakness in the world economy coming through into the hard data? Throughout the year, we've been seeing weakness in the leading indicators, but resilience in the hard data. Now, are we starting to see some of that predicted weakness coming through in the hard data? The JOLTS job opening numbers fell more than expected, but there remains 1.7 job openings for every unemployed worker. So the US labor market remains tight, although it is slackening. And the Logistics Managers Index has hit an all-time low since it began in 2016. Okay, so where are we in the world? Now, the reason I am recording this while on holiday in Crete is that I think we're in a very interesting period in the world economy. The questions are, will we have a recession in the second half of this year? And you know, I've been predicting that for a while, but so far the data has shown much greater economic resilience than I'd been expecting. So to answer that question, we need to see whether the service sector PMIs will begin to weaken. We know that manufacturing PMIs have been very weak, so that the manufacturing sector is slowing, but the service sector has not been slowing. again, everywhere, unemployment has refused to rise. And even as the manufacturing sector has been slowing down, there's little evidence that it's been shedding jobs. And again, the construction sector, which normally leads the economy into recession, will construction activity start to fall? Despite very high interest rates, construction activity has been surprisingly resilient. Also, will the recent bank failures lead to a credit crunch, increasing the chance of a recession? So, to answer that question, we need to see whether deposit flight will continue, sucking liquidity out of the banking system. And when deposits in the banking system fall, then the bank has less money to lend out. And as a result of that, will loan growth start to fall? And loan growth has been surprisingly resilient this year. And finally, will core inflation begin to fall, allowing central banks to halt interest rate rises and begin easing in the second half of this year? So this week's data allows us to start filling in the answers to some of those questions. In the US, we have seen the ISM non-manufacturing PMIs weaken significantly in March, although reminder that the S&P Global Service PMIs actually strengthened in March, and 1 month's data is not a definitive answer. 1 month's data is volatile, so it remains too early to tell, but the ISM numbers would seem to confirm service sector weakness. On the question of unemployment, job vacancies in the US fell, and there was a slight rise in continuing unemployment claims. So the picture is of a labor market which remains tight, but is slowly weakening. Construction activity in the EU and the UK both fell. We have no information on the US this week. Turning to the question of whether the recent bank failures will lead to a credit crunch, increasing the chance of recession, we have some charts later showing that deposit flight is continuing in the US, but not from the US small banks, where deposits actually rose slightly last week. Now, deposit flight from the large commercial banks started well before the failure of Silicon Valley Bank, and has been caused by the much greater yields you can get on money market funds than you can get on deposit accounts, and that is expected to continue as long as that gap in interest rates is available. Now, when people take their money out of a commercial bank and put it into a money market fund, that money market fund then invests in US Treasuries, and that money is not available to be lent out by the financial system. So that should reduce the credit availability of the system. And there were early signs that loan growth is slowing, but we only have 1 week's data. Watch this space. In the Eurozone, we saw that core inflation continued to rise, and that is not encouraging. And on to inflation watch. Well, the only numbers we had this week were for the EU, and CPI fell sharply to 7.1%. That's good news, but core inflation ticked up once again to 5.7%, and core inflation in the Eurozone and everywhere remains well above the 2% targets of the central banks. It is too early to call a turn in the interest rate cycle. Comedy chart. The red line is Eurozone core inflation, and the other lines are the ECB's projections for inflation, and they have been systematically forecasting it will fall, and it hasn't. Now, in the US, the black line is PCE inflation for different categories, and the blue line is CPI inflation for those same categories. And you'll see that there's a puzzling divergence between the two. Not sure what's going on there, but the US government can't seem to agree on what inflation is in these various different categories. One thing I notice is how inflation seems to have fallen off the radar screen, and I'm getting much less information about inflation as the market's attention switches away to the state of the banking system and the chances for recession in the second half, and onto recession watch. Now, this is money supply growth in the EU, and it is very negative. So this is money supply growth in Europe, which is negative, and that has only happened once before in the aftermath of the great financial crisis. So if you believe that inflation is everywhere and always a monetary phenomenon, then inflation should start to come down. Now, this is a big chart. So this is US bank credit, and the big question is whether the recent failures of Silicon Valley Bank will lead to a credit crunch. And the data from last week would seem to suggest that it is. Now, we need to watch this space, as 1 week's data is very volatile and does not necessarily indicate a trend, but that is a worrying data point for the US economy. If we look at the wider US banking system, you'll see that deposits actually flowed back into small US banks last week. So deposit flight there has ceased, but it continued for the larger banks. So as a whole, the US banking system is seeing deposit outflows to higher yielding money market funds. Commercial real estate loans, data to the end of March, also slowed sharply in February and March, having had a great start to the year. But when we look at US total loan growth, the first 3 months of the year look pretty respectable. That is the green line, 2023, and 2022 was clearly a very strong year, but loan growth this year is in line with 2019, i.e. pre-pandemic. Now, loan growth shows very strong seasonality and is generally weak in the first quarter and then strengthens across the rest of the year. So we'll just have to see what happens. Now, we have been reporting for a while now how bank lending standards have tightened, but we haven't really seen that tightening lead to a slowdown in loan growth. Now, this chart shows loan growth lagged by 4 quarters against bank lending standards. And if the relationship here holds, then we should now start to see falling loan growth. And this is deposits in the US banking system, and overall they're falling, and that is not good for credit conditions. Concentrating on the 2 charts at the bottom here, which show loan growth for small and large US banks, there's not much sign of a slowdown as yet. Looking at commercial mortgage-backed securities, well, delinquency rates are starting to rise. And this is data for February before the failure of Silicon Valley Bank, something to watch. The market is very concerned about real estate and how many real estate loans which were taken out when interest rates were very low now need to be refinanced. We're at higher rates when, certainly in the office market, underlying conditions have weakened. One of the puzzles has been the continued strength of the US jobs market. And we have seen layoffs, but they have been largely confined to white-collar jobs, whereas there's been continued strength in the market for blue-collar jobs. And on that point, the February JOLTS job openings showed this unexpected rise in job openings in the construction sector, which is the red line. Construction sector continues to show unexpected strength, but overall the picture is of falling job openings and a slowly declining hiring rate. So the US jobs market does appear to be slowing, but slowing very slowly. Although, reminder, the response rate to the JOLTS survey is now only about 30%. It is the pink line at the bottom. So there's a question over its reliability. Here you see job openings falling and the unemployment rate ticking up marginally. Now, semiconductor shipments are still falling. Various commentators were saying that they appear to be approaching a bottom, but it is too early to call that. US bankruptcy filings are rising, and for the first 2 months of the year, they are the highest since 2011. Now, you'll notice that the bankruptcy rate in 2021 and 2022 were very low as government largesse during the pandemic and afterwards kept a lot of zombie companies alive. We can expect many more failures in 2023 as higher interest rates stress those fragile companies. And this is the Atlanta Fed's GDP now, which previously was showing unexpected strength. Well, it's come off sharply in the last few weeks, although it's still saying the US economy is growing at a respectable 1.7% annualized rate in Q1. And this is Citigroup credit card data for the US, and that is showing a steady decline, which rather contradicts the other data we're seeing on US consumer spending, which continues to show some resilience. But the credit card data is showing some consumer weakness. And reminder, the yield curve is very negative and is very much forecasting a recession later this year. So in summary, deposit flight continues from the US banking system overall, although deposits actually flowed back into small US banks last week. And on the question of whether the failure of Silicon Valley Bank will lead to a credit crunch, well, last week's loan data showed a sharp drop in loan provision. We'll have to wait and see what happens. The recent bounce in US economic growth does seem to be slowing, and there now seems to be a broad weakening in the data. And onto other charts. There's been a lot of speculation in the press about the role of the US dollar in the international financial system, and is the dollar's hegemony coming to an end? Well, if you look at this data, the answer seems to be an emphatic no. So this chart shows which currencies are used in global trade, and they all add up to 200. Reminder that for each transaction, there are two currencies. So the bars for each year sum to 200 rather than 100. But you'll see that the US dollar remains dominant. And although the use of the yuan has grown substantially over the last 15 years, it seems to have grown at the expense of the yen rather than the dollar. And this is an interesting chart. Now, we talked earlier about how the ECB is concerned about listed property vehicles. Well, the blue line is an index of office real estate investment trusts, and the white line is an index of office property prices. You'll see that the listed vehicles have fallen much more than actual office prices. So the market is expecting office prices to fall a lot further. And as investors draw their money out of property funds, so the underlying properties will need to be sold, which will crystallize losses and also force down prices in the real world. And on to good news. Now, I didn't even know there were lions in India, but there are. There are the last remaining Asiatic lions are in the Gir National Park, and their numbers are growing. So 20 years ago, they were only around 300. They're now got to about 700, and they're going to have to create a new sanctuary to accommodate their growing numbers. So when we decide to protect a species, we're generally actually quite good at it. And onto equity markets. So it's generally a good week. The all share was up 1.3%, stocks Europe up 0.9%, S&P 500 up 1.3%, NASDAQ is having a very good year, up 15.5% year to date and up 0.7% this week. Hang Seng was down, as was the topics. Bitcoin faded slightly, but is still up 69% on the week. The dollar had a bad week. So sterling rose 0.4% against the dollar, and the euro rose 0.3%. The dollar index fell by 0.4% and is now down on the year. VIX continued to fall and is at 18.5. Reminder, when it falls below 20, you want to sell. And I have a small spread bet following that strategy, and it had a bad week as the VIX dipped below 20 last week and has continued to fall. So this is the S&P 500. It's had a good few weeks. Now, this is a really important chart, and it shows the S&P 500 compared to fair value based on the US 10-year Treasury yield. And the S&P 500 is currently trading at a substantial premium to Treasury bonds. On this measure, the S&P 500 is overvalued. And generally, when it is this overvalued, it doesn't end well for the equity market. So you can get a much better risk-adjusted return investing in US 10-year treasuries than you can in the S&P 500 at the moment, based on the earnings yield of the S&P 500 compared to US treasuries. Now, junk bond yields have been rising recently, and that tends to forecast falling earnings. But when you look at credit spreads in the US, they're not particularly elevated and they're not rising. Actually, they've been falling in recent weeks. Now, in the US, earnings are contracting. Whichever index you look at, they're falling, which again makes the rising equity prices something of a puzzle. And we talked about this last week, but if you look at the S&P 500, all the performance this year comes from the top 5 companies: Meta, Amazon, Apple, Microsoft, and Google. The broad mass of the index is not doing very well, flat on the year. And corporate profit margins remain high. We've been expecting corporate profit margins to fall as the economy slows, but we know that companies have tended to retain workers following their experience during the pandemic. And so higher costs as they retain workers and falling revenue growth should lead to declining margins. And although margins are down from their recent peaks, they remain high by historic standards. And if you look at the national accounts data for Q4, then it shows that actually non-financial corporations in the US have very high profit margins by historic standards, and those should mean revert and come down, which would be bad for equities. Okay, onto commodities and energy commodities. So after OPEC Plus announced their production cuts, oil had a very good week. Brent was up 7.3%, WTI up 8.3%. So WTI is now up on the year. Natural gas futures continued to decline. Dutch natural gas futures down 1.1%, UK down 3.4%, US down another 3.8%, and US natural gas futures now down 55% on the year over the course of the last 3 months alone. Coal followed oil up, bouncing by 12.5% last week, although it's still down best part of 50% this year. Uranium was flat. Some numbers specific to the oil market. Well, in the US, we continue to see drawdowns. So inventories fell by a massive 11 million barrels. So the US market is currently undersupplied, and that should be bullish for oil prices. US crude production was flat at 12.2 million barrels. The Baker Hughes rig count fell by 3. This is crude showing a strong bounce, and in recent days, it has been stable, well up from its lows. So the OPEC Plus production cut is seen as a defensive measure against falling oil demand as the world economy slows. And long-view economics are forecasting that despite the cuts, the oil market will remain in surplus for the rest of 2023. However, a lot of other commentators are forecasting a deficit in the second half of the year. We'll just have to wait and see how bad the economic slowdown becomes. Generally, recessions, and reminder, we're forecasting recessions in the second half, are bad for oil demand. So let's go through the non-OPEC countries. And non-OPEC crude supply is forecast to grow over the coming years. So we have data to November last year, and the red line is forecasts. So you see that over the course of the next 3 years, you're going to see a slight increase in non-OPEC production of only about 1% over the course of the next 3 years. And non-OPEC production was forecast to hit a low this month of 50 million barrels a day. So some of the large drawdowns in US oil inventories can perhaps be explained by that seasonality in oil production from non-OPEC countries. And going through the non-OPEC oil producers country by country and looking at the trends in production, this is Brazil, where production has generally been rising. Canada, where it's definitely slowly rising. China, where I think, again, you can say it's been rising from its lows in 2018. Kazakhstan has recovered recently, but production there, I think you'd say, is flat. This is Mexico, where production has been stable for a few years after its previous precipitous declines, and production is not forecast to grow in 2023 as declines from mature fields more than offset new production. This is Norway, which again is stable. Oman has been growing steadily recently, although it dipped in November, which I have the latest data for. Qatar production stable. Russia has recovered well from sanctions, and the forecasts were very much that sanctions would lead to a fall in production as Western expertise and equipment was withdrawn from the country, but that doesn't really seem to have happened, although there is some debate about the numbers. As you can see, the Russian oil ministry more optimistic than the EIA. UK is in steady decline, frankly. UK production over the last couple of years has been pretty stable, although the long-term picture is of steady decline. The US is the big hope for non-OPEC production, and it is forecast to keep rising, but that growth rate to really slow down. So of course, next year, expecting to see a rise of only about 3 to 4% in total production. And then combined, 6 other small important producers, that's Colombia, Azerbaijan, Indonesia, India, Egypt, and the UK, you should see a steady decline. So in the year to November 2022, world production overall grew by 5%, which is much more than I'd been expecting. And we are currently at the low for the year. So April production is expected to be the nadir. So production is forecast to recover quite strongly in the next few months. This obviously was before the OPEC plus cuts, but therefore cuts will start in May. Okay, and this is US natural gas, which continues to drift off. And the problem for the US natural gas industry is that a lot of the increase in natural gas production comes from the Permian, where it is a byproduct of oil production. And so because oil prices are high, that gas will keep on being produced. And so there will be no supply cutbacks from the Permian. And you see that the Permian is the majority of associated gas production in the US. So that is bearish for US natural gas prices. Okay, on to industrial commodities, and generally a bad week. So although equity markets had a good week, commodity markets are more pessimistic about the outlook for the world economy. And aluminium was down 2.2%, cobalt was flat, copper was down 1.7%, chromium down 0.7%. Iron ore fell by 3.2%, although it's up 3.4% for the year. Lithium carbonate continued to fall, down another 11% last week and down 60% in the first 3 months of the year. Neodymium fell another 2%. Nickel down 4.6%, now down 24.7% on the year. Tin down 5%. Ferrovanadium down 4%, zinc down 4.4%. So a very bad week. As I'm on holiday, we won't be doing charts. Charts will resume when I get back. Turning to precious metal, gold had a good week, up 1.4%, up 10% on the year. Silver followed gold, is up 4.2% on the week and is now up on the year. Platinum had a good week, up 2.1%, although it's down 6.6% on the year. Rhodium fell 6%, was down 36% on the year. Palladium was flat. And this is gold price, and fears over the stability of the global monetary system and coming recession have led to a flight to safe havens, including gold. And silver has followed gold. So gold and silver, the monetary metals, doing much better than the other precious metals. So turning to rates, well, weakening economic data has led to falls in bond yields across the curve. So in the UK, the 1 year fell by 4 basis points on the week, and the 50-year fell by 6 basis points. The whole yield curve shifted down. There were steeper falls in the Eurozone. So Greek 10-year yields fell by an enormous 30 basis points this week, Italian by 20 basis points, and there is no indication of a return of the Eurozone crisis. This is our views on the various asset classes and no change. So in summary, there are signs that macroeconomic data is starting to weaken. Early data indicate that the recent bank failures have led to a tightening of credit conditions, but 1 week does not make a trend, and we'll have to monitor that in the coming weeks. And onto my portfolio. Well, the fall in bond yields was good for me. I was up 0.8%. The all share was up 1.4%. So I underperformed the all share. And I'm also underperforming the all share year to date. I'm up 2%. The all share is up 3.3%. Regular viewers will know that I am expecting a recession in the second half of the year, leading to falls in interest rates and falls in long bond yields. And previously said that the trigger for putting this trade on would be when US 1-year yield fell below Fed funds rate, and that trigger continues to show that it's time to start putting this trade on. Now, I have been way too early, but I felt this week that the data was really starting to turn, and having cut the position a couple of weeks ago, I added to it and I bought some of the 2068 UK index-linked gilt, and the trend is generally upwards. Reminder that in 2021, the T68 was priced at £300, and it hit a low of about £80 back in March and has now reached 100. So this is an incredibly volatile instrument. But I think as the economy slows and interest rates come down, then it will recover to somewhere towards the middle of that range. So I'm hoping it will get back to around 150. Okay, thank you all for watching. Please can you press like and subscribe to the channel. I am in Crete for 1 more week, so I'll be aiming to get out another abbreviated weekly next week, and then normal service will resume in a couple of weeks. In the meantime, it is goodbye from me, Keith Jordan. Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.